Microsoft stock is currently trading at $403.01 during intraday action on this Thursday, April 30th, 2026. The price is currently down about 5.05% today as the market digests a complex set of variables following a high-stakes earnings week. While most investors were looking at the surface-level beats on revenue and earnings per share, the real story causing this immediate friction in the price action is the massive surge in capital expenditures. Microsoft just reported a staggering $37.5 billion in capital spending for the most recent quarter, a move that effectively signaled to the market that the arms race for infrastructure is far from over. This is the reality that is clashing with the expectation that we would see these costs start to taper off as the systems matured. Instead, we are seeing a doubling down. The common belief right now is that Microsoft is the safest bet in big tech because of its diversified revenue streams, but the contrarian take is that the company is currently in a build-at-all-costs phase that is putting immense pressure on its short-term free cash flow. If you look at the recent daily swings, we've seen Microsoft move from a high of $433.70 just over a week ago down to these current levels near $400. Institutional activity has been particularly heavy, with trading volumes spiking well above the 30-day average of 34 million shares. Many of the big players are rebalancing their portfolios as they weigh the impressive 39% growth in Azure against the reality that maintaining that lead requires spending tens of billions of dollars every single quarter on semiconductor procurement and data center expansion. When you look at the movement today, it's clear that the market is punishing the stock for its aggressive spending outlook, even though the core business is arguably healthier than it has ever been. For anyone using investing sites or keeping an eye on their Fidelity mobile app, this kind of volatility in a mega-cap name can be unsettling. However, it's important to separate the noise of a single trading session from the long-term momentum. The sector momentum for cloud services remains the primary engine here. Microsoft Cloud revenue hit $82.9 billion this quarter, which was an 18% increase. That is not a small feat for a company of this scale. It shows that while the costs are rising, the demand is actually keeping pace. The tension between those two figures is where the stock's future value will be decided. Comment below how many shares of Microsoft stock you currently hold, or if you are waiting for a deeper dip to add more to your position. To understand why the stock is behaving this way, we have to look at what Microsoft actually is in 2026. It has moved far beyond being a software provider. Today, it operates as the digital backbone for the global economy. Through its intelligent portfolio of services, it touches everything from corporate productivity via Microsoft 365 to the hardware through Xbox and Surface, and of course, the massive cloud infrastructure of Azure. Its business model has shifted toward high-margin recurring revenue, which is why it usually commands such a high price-to-earnings multiple. In the past, a PE of 26 might have seemed rich, but in a world where Microsoft is effectively a utility for the digital age, many analysts see this as a baseline. Looking at the older reports, we can see a clear trend. A few years ago, the focus was on the transition to the cloud. Then it shifted to the integration of intelligent assistants into every facet of the Office suite. Now the reality is about agentic computing, the idea that software won't just help you write an email, but will actively manage workflows and scientific discovery. This is why the capital expenditure is so high. They aren't just buying servers, they are building the factories for the next generation of logic. For those using an individual brokerage or exploring SoFi active investing, the historical context matters because it shows that Microsoft has a track record of spending heavily today to dominate the market 5 years from now. We are also seeing significant macroeconomic pressures. With oil prices fluctuating and the Fed performing a delicate balancing act with interest rates, high-growth tech names are often the first to feel the heat of a risk-off sentiment. If inflation proves stickier than anticipated, the cost of debt for these massive infrastructure projects increases, even for a company with a balance sheet as strong as Microsoft's. This is why you see such heavy activity on the Interactive Brokers platform and other high-end trading tools. The pros are hedging against the possibility that these massive investments take longer to pay off than the retail crowd expects. The institutional side of the house is also watching the competition. While Microsoft has a lead, Alphabet and Amazon are not standing still. The recent pullbacks in Microsoft stock are often a reflection of the market trying to figure out who will ultimately own the highest share of the cloud market. Right now, Azure is growing faster than its rivals, but that lead is expensive to maintain. If you're checking your Robinhood app or Schwab Intelligent Portfolios today, you're seeing the result of that uncertainty. The reality is that Microsoft has the most integrated ecosystem, but the expectation was that they could win without spending $150 billion a year on hardware. The market is now realizing that the moat is built out of silicon and electricity, and those aren't cheap. Looking toward the future, the catalysts are quite clear. The upcoming launch of specialized AI models for cybersecurity and healthcare could provide another leg of growth that isn't yet fully priced in. If Microsoft can prove that these agentic systems can actually reduce headcount costs for their enterprise customers, the subscription fees they can charge will skyrocket. On the flip side, the risks involve regulatory scrutiny and the potential for a multiple compression where investors decide they aren't willing to pay 26 times earnings for a company that has to spend half its profit just to stay relevant. Expectations for the next quarter are already high, with revenue guided to land between $86.7 billion and $87.8 billion. If they hit the high end of that range, the current dip will look like a massive oversight by the bears. However, if the growth in Azure slows down even by a percentage point, the reality of the high spending will become a much heavier anchor on the stock price. This is the storytelling of the market, the constant tug of war between the vision of a fully automated future and the quarterly math of a balance sheet. In summary, Microsoft remains a titan that is currently being tested by its own ambition. The live price of $403.01 reflects a market that is momentarily spooked by the price tag of progress. We started with the expectation that the post-earnings reaction would be a simple victory lap, but the reality of the capital expenditure has created a curiosity loop about the company's long-term margin profile. By looking at the trading volumes and the institutional moves on platforms like Interactive Brokers or Fidelity, we can see that the smart money is still very much engaged, even if the daily swing is painful. Microsoft is betting everything on the idea that they can become the indispensable platform for the next 20 years. Whether that reality exceeds the current market expectations is the only question that truly matters for your portfolio. The depth of their integration into the global economy gives them an authority that few companies can match, but as we've seen today, even the biggest players have to answer to the reality of the tape.